Imagine waking up one morning to find that two of the world's fastest-growing and most influential economies have decided, almost overnight, to rewrite the entire rulebook on international trade. That is not just a fantasy scenario. It is exactly what happened when President Prabowo Subianto of Indonesia and former United States President Donald Trump picked up their phones and made a historic call. In mere moments, these two leaders shattered years of precedent, sent tremors through the global economy, and set in motion changes that could redefine Asia's future, shift the world's power balance, and impact your investments for decades to come. But how did we arrive at this extraordinary turning point? To truly understand the magnitude of this moment, we need to journey back through the often overlooked, yet deeply consequential relationship between Indonesia and the United States. A relationship shaped by cautious optimism, missed opportunities, and the relentless pursuit of economic growth. For more than half a century, the economic partnership between these two nations could best be described as pragmatic, transactional, and sometimes even uneasy. While trade between Indonesia and the United States has grown steadily since the end of the Cold War, it has never reached the scale or strategic depth that either nation truly hoped for. Despite being home to more than 270 million people and boasting the largest economy in Southeast Asia, Indonesia often found itself overshadowed on the world stage by economic giants like China, India, and Japan. The numbers tell a revealing story. The United States, long one of the world's leading importers of goods and services, has struggled with a persistent and growing trade deficit with Indonesia. By the year 2024, this deficit had ballooned to nearly 18 billion United States dollars, a more than 5% increase from the previous year. American consumers bought mountains of Indonesian textiles, electronics, and natural resources, yet the flow of goods moving the other way. American exports into Indonesia remained comparatively modest. And yet, beneath the surface, Indonesia holds some of the world's most coveted economic assets. Immense reserves of nickel, copper, and cobalt. These minerals are absolutely essential for the green energy revolution, powering everything from electric vehicles and wind turbines to smartphones and advanced batteries. With the planet pivoting toward clean technology, Indonesia's mineral wealth is nothing short of strategic gold. Despite these strengths, Indonesia often found itself on the sidelines of the world's biggest trade deals. While China, India, and even Vietnam attracted wave after wave of foreign investment, Indonesia's complex regulatory environment and history of protectionism made foreign investors cautious. The Trade and Investment Framework Agreement, signed between Indonesia and the United States in the mid-1990s, was intended to foster deeper integration. But for nearly 3 decades, progress remained painstakingly slow, with both sides wary of giving too much away. Then came an era of global uncertainty. Tariff wars erupted between major economies. The COVID-19 pandemic upended global supply chains, exposing vulnerabilities and sparking international competition for vital resources. Against this turbulent backdrop, the United States threatened to impose a punishing 32% tariff on Indonesian exports, a move that would have been devastating for Indonesia's thriving manufacturing sector, from its garment factories to its electronics assembly lines. For American companies eager to tap into the vast Indonesian market, the 4th largest population on Earth, the stakes were just as enormous. It was at this crossroads that something truly remarkable unfolded. President Prabowo, newly elected and eager to secure Indonesia's economic future, reached out to Donald Trump, whose reputation as a dealmaker and disruptor preceded him. What followed was a phone call that would become the stuff of modern economic legend. As Prabowo later shared with his millions of followers on social media, the two leaders did not just exchange pleasantries, they acted decisively. Within hours, Donald Trump broke the news on his Truth Social account. Both nations had agreed to what he termed a landmark deal, one that would, in his words, open up Indonesia's entire market to the United States for the first time in history. The threatened 32% tariff on Indonesian goods was immediately slashed to 19%, a rate significantly lower than what Indonesia's key regional rivals, such as Malaysia, Vietnam, and Thailand, currently face when exporting to the United States. But that was just the beginning. In exchange for this unprecedented tariff cut, Indonesia committed to a series of ambitious purchases. 15 billion United States dollars worth of American energy products, from liquefied natural gas to advanced solar technologies, $4.5 billion in United States agricultural products, including wheat, soybeans, and premium beef, and a headline-grabbing order for 50 Boeing aircraft, primarily the latest 777 models. These commitments, if fulfilled, would represent some of the largest cross-border purchases in Indonesia's modern history. Perhaps most significantly, under the new agreement, United States exports to Indonesia would become entirely tariff-free and exempt from non-tariff barriers. Gone would be the bureaucratic obstacles and hidden costs that have long frustrated American exporters. For the first time, American businesses, from agricultural giants in the Midwest to high-tech firms in Silicon Valley, would have unimpeded access to one of Asia's most dynamic and promising markets. The reaction in Jakarta was immediate and euphoric. Erlangga Hartarto, Indonesia's coordinating minister for economic affairs and the architect of the Indonesian negotiation team, hailed the deal as a crucial step in boosting bilateral trade and attracting new investment. Local economists, such as Fakhrul Fulvian of Trimega Sekuritas Indonesia, pointed out that the 19% tariff gives Indonesia a rare competitive edge. In a region where neighbors face tariffs as high as 25% or more, Indonesia's manufacturers and exporters suddenly found themselves in a privileged position. International financial markets responded with optimism. Bloomberg analysts predicted a surge of positive sentiment in Indonesian asset markets, citing the expected influx of foreign direct investment and the likelihood of new infrastructure, technology, and energy projects. In the days following the announcement, the Jakarta Stock Exchange saw an uptick in trading volume, and the rupiah, the Indonesian currency, strengthened against the dollar, reflecting renewed investor confidence. Yet not everyone was convinced. Howard Lutnick, the United States Trade Secretary, struck a notably cautious tone. "There are no tariffs there, and they are paying tariffs here," he observed, underscoring the one-sided nature of the deal's core provisions. American exporters would now enjoy unprecedented freedom in Indonesia, while Indonesian goods would still face a substantial, albeit reduced, 19% tariff in the United States. This disparity has sparked fierce debate within Indonesia. Some local manufacturers and labor unions fear that the flood of tariff-free American products, everything from advanced machinery to packaged foods, could overwhelm domestic industries, making it harder for Indonesian companies to compete on their own turf. There are also worries that Indonesia's ambitious promises to buy billions in energy, agriculture, and aircraft may be difficult to fulfill, especially if global market conditions shift or budget constraints emerge. Beyond the economics, there is a powerful geopolitical undercurrent to this agreement. With China watching these developments closely, many analysts see the United States-Indonesia deal as a strategic chess move in the broader contest for dominance over Southeast Asia's critical minerals and supply chains. Indonesia's vast stores of nickel, copper, and cobalt have already attracted considerable Chinese investment. By tilting more toward Washington, Jakarta may be recalibrating its foreign policy, sending a clear signal that it is no longer content to be a mere bystander in the global race for resources and influence. Some experts speculate that China may respond with its own countermeasures. These could range from imposing stricter regulations on Indonesian imports to offering more attractive investment terms to Indonesian companies. There is also talk of China accelerating its efforts to develop alternative sources of critical minerals, reducing its reliance on Indonesian supplies. Meanwhile, the practical details of the deal raise additional questions. For instance, the agreement stipulates that Indonesia will apply the 19% tariff to any transshipment of goods originating from countries with higher existing tariffs, even if those goods are repackaged or relabeled in Indonesia. This measure is designed to prevent trade circumvention, but it also adds a layer of complexity to international supply chains and could impact regional trade flows. For the average Indonesian citizen, what does all this mean? On the one hand, increased American investment and access to advanced technologies could translate into new job opportunities, higher wages, and improved standards of living. If Indonesia succeeds in attracting new factories, tech startups, and infrastructure projects, the benefits could ripple across the archipelago, from the bustling streets of Jakarta to the rural villages of Sumatra and Sulawesi. On the other hand, there is a real risk that the deal could deepen Indonesia's dependence on American imports, particularly in sectors like energy and agriculture. The commitment to purchase $15 billion in American energy products and $4.5 billion in agricultural goods is unprecedented for Indonesia. If these deals come at the expense of local producers or lead to price volatility, they could spark resentment and economic instability. For American businesses, the stakes are equally high. With more than 270 million potential customers, Indonesia represents one of the last great untapped markets for everything from smartphones and electric vehicles to digital services and healthcare. The removal of non-tariff barriers, such as licensing restrictions, local content rules, and complex customs procedures, will make it easier than ever for American companies to enter the Indonesian market. But success will require more than just shipping products across the Pacific. American firms must invest in building long-term relationships, understanding local consumer preferences, and adapting their products to the unique cultural landscape of Indonesia. Let's also consider the broader regional implications. Southeast Asia is home to more than 650 million people and has emerged as a pivotal arena in the global competition between China and the United States. In recent years, countries like Vietnam, Thailand, and Malaysia have jockeyed for position, leveraging foreign investment and trade deals to turbocharge their economies. By securing a more favorable deal with the United States, Indonesia is signaling its intent to be a regional leader, not just an economic powerhouse, but a diplomatic force to be reckoned with. Yet the road ahead is fraught with challenges and uncertainties. The agreement's success will hinge on both sides upholding their commitments and ensuring that non-tariff barriers, those hidden hurdles like paperwork, standards, and regulations, do not undermine the spirit of the deal. There is also the ever-present risk of political shifts. A change in leadership, either in Jakarta or Washington, could bring a reassessment of priorities. As history has shown, trade agreements can be fragile. Just look at the fluctuations in United States trade policy over the past decade, from the Trans-Pacific Partnership to the various tariff battles with China, the European Union, and others. From a historical perspective, this deal echoes some of the world's most transformative economic agreements. Think back to Japan's post-war trade boom with the United States, or the North American Free Trade Agreement's reshaping of commerce between the United States, Canada, and Mexico. In each case, bold policy shifts unlocked decades of growth, but also unleashed new waves of competition, adaptation, and at times, backlash. The United States-Indonesia agreement could very well become the defining trade story of the 21st century in Asia. For investors, the implications are enormous. Indonesian assets, stocks, bonds, and real estate are likely to benefit from rising foreign capital inflows. Already, major investment banks are revising their growth forecasts for Indonesia upward, predicting faster economic expansion, a rising middle class, and increased consumer spending. American companies that have long struggled with regulatory bottlenecks in Indonesia are preparing to ramp up their presence, from tech behemoths like Google and Microsoft to agricultural exporters in the Midwest. But as with any major shift, there are risks. Some Indonesian policymakers warn that a rapid influx of foreign capital could destabilize local markets, create asset bubbles, or lead to a hollowing out of domestic industries. Others caution that the increased reliance on American goods and technology might erode Indonesia's economic sovereignty in the long run. These are not idle fears. The experiences of other emerging economies, from Mexico to Brazil, offer sobering lessons about the double-edged sword of globalization. So what does this all mean for you? Whether you are an entrepreneur, an investor, or simply a curious citizen, the first and most important lesson is that trade deals are never just about tariffs or headline figures. They are about power, leverage, and the complex interplay of national interests. For Indonesian business owners, the United States market is now more open than it has ever been. This could be the moment for local tech companies, specialty manufacturers, and creative industries to make their mark in North America. But with opportunity comes competition. American firms are agile, innovative, and relentless. Indonesian exporters will need to up their game, invest in quality control, and adapt to the demanding standards of the United States market. For American farmers, manufacturers, and tech giants, Indonesia's vast market offers a tantalizing opportunity, but also a challenge. Winning over Indonesian consumers will require more than just competitive pricing. Cultural sensitivity, localization, and long-term commitment will be key. Companies that succeed will be those that invest in local talent, build genuine partnerships, and give back to the communities in which they operate. For everyday people, the effects of this deal may be subtle at first, but will become increasingly visible over time. You might notice more affordable American products on store shelves in Jakarta, or see Indonesian tech startups expanding into United States markets. If you are an investor, keep an eye on sectors poised for growth: renewable energy, digital infrastructure, logistics, and advanced manufacturing. These are the industries most likely to benefit from the new trade dynamics. There is also a critical lesson here about the invisible power of policy. The agreements negotiated in faraway capitals, often behind closed doors, can have direct, tangible impacts on your daily life. They can influence the prices you pay for goods, the jobs available in your community, and the opportunities open to your children. That is why it is more important than ever to stay informed, ask tough questions, and follow the money. The next seismic shift in the global economy could well begin with a single phone call between presidents, or even a tweet sent in the dead of night. So, will this bold new era of mutual benefits between Indonesia and the United States truly deliver for both nations? Or are we witnessing the opening moves of a new zero-sum game, cloaked in the language of partnership and prosperity? The answer, for now, is a cautious and watchful optimism. If both sides manage their relationship with care, ensuring fairness, enforcing high standards, and building genuine trust, this agreement could set a new benchmark for 21st century trade. But if one side dominates, or if geopolitics take a darker turn, the dream of a balanced and equitable partnership may slip away, leaving both nations to reckon with the consequences. So what should you do next? If you found these insights valuable, do not forget to subscribe to our channel, share your thoughts in the comments, and let us know which global trade story you want us to unravel next. Stay curious, stay informed, and join us for the next deep dive into the world of economics and technology. Because, as we